Two stocks I'm buying over the next 20 days, and I have a video coming up explaining why I believe this sell-off is not gonna last more than 20 days, but I'm gonna share those two stocks with you guys on YouTube. I believe those two stocks could massively outperform coming out of this pullback, and I think the second one especially could really surprise a lot of people and pull off a Alphabet or a Google-like move. It's a hated stock with really good fundamentals, and I normally don't share those stocks a lot on YouTube. So if you do enjoy it, all I'm asking is please press the like button and let me know what you think in the comments. Now, normally, whenever we have a pullback or some kind of a sell-off, the biggest mistake investors make is they start buying a lot of the cheap stocks. For example, they buy, I don't know, stocks like PayPal, which PayPal is a good company and I like the stock. But really, whenever you have such sell-offs, you want to buy the stocks that don't normally sell off very often. Maybe stocks like the Big Seven, which you rarely get at fair value or at undervalued levels. Maybe it's a lot of the quality stocks, like really, really amazing companies. This is not the time to really be buying a lot of value investments or dividend stocks, in my opinion. And what I'd be doing in my personal portfolio is I'll be focused on some of the big seven stocks, as I'm personally underweight this sector in general. Now, the first stocks that I believe could do extremely well out of this pullback is Meta. Meta is down 6.5% on the month. Meta is just an amazing company. They have almost 3.5 billion daily active people, and this is the reach that Meta has. Imagine the upside in terms of monetizing 3.5 billion people on your platform. It's not priced in the stock. So this is a stock that has a lot of, you could say, hidden treasures, hidden gems that aren't really priced in the company. It has a lot of hidden value if you really think about it. I mean, you're reaching 3.5 billion people, and you have them on WhatsApp where you're not even monetizing them. So what is the potential of that? It could potentially be explosive. The average revenue per person has been steadily increasing, not a lot, but it has been steadily increasing, which is amazing. Expenses as a percentage of revenue, they've been very disciplined with expenses, and it's been actually steadily decreasing, and it's been coming down over time, which is amazing. Now, my favorite part about Meta is really how much they reinvest in themselves. So the company makes 71 billion in net income. From the 71 billion, they spent 48 billion dollars in just research and development. The company already has Instagram, they already have Facebook, they already have WhatsApp, they already have all those apps. Those apps are not going anywhere, maybe not 5 or 10 years from now. TikTok came in, a lot of apps came in, and those apps are still here. But the company is trying to find ways to get better and to better themselves. So net income is 71 billion after the company spent $48 billion on research and development. Like, if they just pull back research and development by 50% to, let's say, 25 or 27 billion, the company would still survive. Trust me, Instagram would still be here, Facebook would still be here, but the net income of the company would increase by 30 or 35% overnight. This is the kind of leverage that the company has. So you're saying good net income number, but this is after they spent so much on reinvesting in themselves. And then on the free cash flow side, they're spending 30 billion year to date on just capital expenditure. So year to date, or every year, they spend about $100 billion between CapEx and research and development on themselves to improve their modes, find new products, to remain competitive. And they don't really have to spend this much, but they're choosing to do so. And if they decide to, you know what, we're gonna pull back on that CapEx spending a little bit and maybe do some buybacks, maybe do some dividends, or maybe we're gonna pull back on research and development a little bit. The 23 PE ratio that we're all looking at, which I don't believe is too high, or 24 PE, could end up being 21 or 22 PE if they pull back on research and development, or even 19 PE, and the company would still survive. So this is the kind of gross leverage that the company has. This is the hidden value that the company has, despite having access to 3.5 billion people. I mean, access of that and the potential monetization is absolutely insane. The company still has a good balance sheet. They have 47 billion in cash and 28 billion in long-term debt. So the balance sheet is great. Now, for my upside potential on the stock, I put in the current PE ratio for 2025. and I put in 15% earnings per share growth over the next 5 years, I believe is fair. Although the analysts are expecting a deceleration down to 7% next year and 15% 2027. And this could be possible. But based on the growth trajectories that I'm seeing from Meta and the pricing power and how everything has been holding up, unless we have a major recession next year, I don't believe Meta will only grow 7%, and it will likely grow more than 15 in 2027 from the recovery. So that's why I'm putting up 15% for the next 5 years. I believe this is fair. Now, the PE ratio right now is around 24.7. I put in 23 PE, even though 23 PE isn't really too high, but this is, the historical average, and I don't normally like to pay much more than the historical average in all of my stocks. Meta traded as low as 20 PE, even sometimes 18 PE in the April sell-off. I'm not expecting it to go back to 18 PE, but I personally wouldn't pay much more than 23 times earnings. That's just for me to feel comfortable. And I have the tiny dividend of 0.29, which only makes Mark Zuckerberg rich. Now, in this case, if you're buying Meta today, you're only getting 13% on the upside. So if you want to get a double or 15% return every single year for the next 5 years, you would have to buy Meta at $642. So for me personally, I'm looking to start buying Meta under 650 during the sell-off. If Meta gets to 650 or below, I'm highly likely to start opening up a position. I really like the setup. I love the company. I love the competitive advantage. I love everything about it, but I'm disciplined in not really overpaying. I realize that if a company is amazing, but if I pay too much, I could still potentially lose money. So I'm not a big fan as a beginner value investor. When I started out, I was a value investor. I'm not really a big fan of really paying up too much for things. So if it gets under 650, I will likely start a position. And I think this is very, very possible. Now, the second one, which potentially has explosive upside, which is in my portfolio, and I will likely be taking it to a much larger position. I'm planning to aggressively buying the dip on this one. I think it could make a Google-like move, and this is Amazon. Now, if you look at Amazon, it's down 1% year to date. Microsoft, Alphabet, Nvidia, all the big seven, they're pretty much killing Amazon. And Amazon is not only underperforming as all those stocks are going up, it's only outperforming on the way down because it's down much more over the last months than any of the big seven stocks. So the stock has been a disaster and a lot of bad sentiment on X. People are starting to give up, doubt the stock, selling it to buy Meta or selling it to buy Google. They're just giving up. And this is the kind of sentiment I like. I like bad sentiment and I like good fundamentals. And that kind of reminds me back in 2022, whenever Amazon Web Services didn't really grow or it declined quarter on quarter, the market freaked out and the stock sold off and people called it dead. The same way they called Meta dead whenever their, I believe, daily active people declined for one quarter. I mean, do you really expect perfection every quarter, guys? I mean, sometimes those businesses, they struggle a little bit. Sometimes it's not a straight way up, even in your own life, in your investing journey. Sometimes you gotta make mistakes, you gotta lose money, you gotta recover, learn a lesson, and then move on. It's not successes every single day. It just doesn't happen this way. And it's the same thing with those companies. So that's what happened back in 2022. And I think the same thing is kind of happening right now. But this is really Amazon Web Services, and I would call it Amazon dead services, because if you again look at the sentiment, people believe it's just like it's dead. But AWS still has a 30% market share, Azure has 20%, and Google Cloud has 13%. So the company is way ahead of Azure, way ahead of Cloud. Now, yes, Azure and Cloud are growing faster, but they're much smaller than Amazon Web Services. I mean, if a company is, let's say, $1 billion company, okay, they make $100 million in revenue, it's going to be much easier for them to grow 50% in revenues than a company that's making $100 billion in revenues to grow their revenues by 50 billion. I mean, that's just common sense. And it's the same thing with Cloud and Azure. Once they start getting bigger in size, their growth rates will likely start to decline. That's just the law of numbers. And I believe that's what's going to happen. But something that's very interesting that I've been studying more recently is if you look at Microsoft Azure's growth, most of their growth has mostly been driven by OpenAI. So they're officially the partner of OpenAI. OpenAI use a lot of computing and power capacity. And there's a cloud provider of OpenAI. And a lot of the Azure growth has been driven by OpenAI. And as you know, they have a stake in OpenAI. So this is something that Microsoft Azure has that Amazon doesn't really have. But Amazon has its own OpenAI, and this is called Anthropic. Anthropic, I talked about it a few times. It's close to OpenAI, but it's not really a consumer-based product. It's more of an API business-related AI kind of product, and it's actually facing massive growth if you look at this chart. And if you compare it to OpenAI, the API business of Anthropic is pretty much killing OpenAI. They're getting 4 billion, OpenAI is at 2 billion, and Anthropic is expected to massively overtake OpenAI in a major way, grow much faster in terms of API for businesses in general. And if you look at the revenue growth trajectory, OpenAI is at 12 billion annual run rate, Anthropic is at 4 billion annual run rate, and now the gap is 3 times between the two. It used to be 20 times in 2022, and I believe Amazon owns 20% of Anthropic. So this is a pretty decent competitor to OpenAI, in my opinion, and Amazon will do really well from that. But where Amazon Web Services will benefit is there's a lot of those data centers that are being built to serve Anthropic's growth, and a lot of them are coming online. And once they start coming online, the growth of AWS is expected to pick up in a major way from 18.5, 21, 23, 25. And they're going to have this kind of flywheel cycle the same way that Microsoft Azure has it, where the more OpenAI grows, the more they invest in it, the more they're going to use power from Microsoft, and the more Microsoft Azure will benefit. And it's going to be the same thing with AWS. And it could come as soon as the second half of 2025, and it could cause a massive change in sentiment. But Amazon is not just about AWS. Amazon is also about logistics. They have a logistics kind of mode. They are a leader in terms of parcel volumes. They're overtaking UPS, and very soon they're going to overtake USPS. This is absolutely mind-blowing. From a nothing business to 27% market share. The company has tons and tons and tons of square footage, and they keep reinvesting in real estate. They reinvest in themselves, new businesses. They don't do buybacks. They don't do dividends. And this is something that I like personally. I like the company that is still finding places to reinvest in itself, because normally once a company starts doing buybacks and dividends in a major way, it's just screaming that I'm not finding better place to put the money, so I'm going to give it to you. But Amazon is not like that, and they're still reinvesting in themselves. And there's a lot of younger businesses. One of them could, like the Amazon Pharmacy, where it's like a vending machine with prescription drugs. They started it recently, and maybe this could potentially be a success. So there's a lot of potential call options with a company like Amazon. Now, if you look at the whole setup, you look at where Amazon is relative to the Big Seven this year, you look at what could potentially happen in the second half due to Anthropic and the AWS stake and partnership. And if you look at the sentiment in general and everything that's happening, and we combine it with the valuation is now around 14 times price to operating cash flow, the lowest since August of 2025. Now, 14 times price to operating cash flow is dirt cheap. Whenever you're growing operating cash flow at 21%, 21%, 20%, so you're buying a wide mode mega cap like Amazon for less than 1 times its growth, less than 1 times price to earning growth, combined with bad sentiment, combined with a catalyst of Anthropics that could hit in the second half of 2025. To me, that makes me very, very excited, and it makes me want to buy a lot of Amazon stock. Now, yes, a lot of it is being spent on capital expenditures, but a lot of that capital expenditure, which is 100 billion, again, most of it is not maintenance capex, is gross capex, because the company is trying to grow, is trying to widen their moats, they're expanding internationally in many different areas, and they can really pull back on that anytime. But I like Amazon because really, Amazon, anytime they can pretty much decide that, okay, we're going to start focusing on making profits from those businesses. We're not going to focus on taking market share. Now they're focusing on not making much money, but taking market share. And then once they take the market share, then they make it profitable. But if they focus on being profitable, the company's profits could maybe go up by 30 or 50% overnight. So this one is another one that has a lot of, you could say hidden gems or hidden call options within the company. So I like Amazon very much. I think it has explosive upside. I also like Meta. I will highly likely be buying both of them over the next 20 days. And I will likely be trying to look for another growth stock. I normally try to find one growth stock every sell-off. And I actually shared a free write-up on my Patreon, and it's linked in the X account, and it says how I doubled my portfolio over the last year. And I showed you how I find multi-baggers like Robinhood. It's like a checklist of what you look for on metrics. And, it could be helpful, and you could maybe read it and maybe find your own kind of stocks. As I found, Robinhood, HIMS is up for me 550%. Mama is up 500%. And I found many of those stocks. And if you decide to join me on my journey of finding those things and seeing what I do over the next 20 days, you could potentially join my group. And this is the link if you're interested. But thank you again. Not financial advice. Hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.